Namaste friends, myself Prakash Sharma. I am happy to share with you another episode of Pahal. Today we will understand about a topic with which many small transport businesses are concerned, that is the filing of income tax returns under the Presumptive Taxation scheme. Once the financial year is over, many of us are under pressure to file the annual income tax return. There is no need to take any tension. Today we will learn about the basics of income tax and how easily you can file the ITR on your own with minimum hassle. We'll talk in detail about the sections related to maintenance of accounts, audit of accounts and filing of ITR 3 and ITR 4 under the presumptive taxation scheme. If you want to get more knowledge about the basic concepts related to income tax and return filing, please watch my video on ITR 1, the link for which is shared here. What is presumptive taxation scheme? Normally, books of accounts must be maintained and a profit and loss account and balance sheet must be prepared to know the income and the financial status of a business or profession. However, under the Income Tax Act 1961, a simple method has been provided for small transport businesses to work out the income for tax return purpose. A person adopting the presumptive taxation scheme can declare income at the prescribed rates. We'll see the different sections prescribing the scheme of presumptive taxation and explain the same. We'll begin with Section 44A, maintenance of accounts by certain persons carrying on profession or business. Books or books of account includes ledgers, day books, cash books, account books and other books, whether kept in the written form or in electronic form or in digital form or as printouts of data stored in such electronic form. Every person carrying on business or profession not being a profession referred to in subsection 1 shall, if his income from business or profession exceeds 1,20,000 rupees or his total sales, turnover or gross receipts as the case may be in business or profession, exceed or exceeds 10 lakh rupees in any of the 3 years immediately preceding the previous year. Or clause 2, where the business or profession is newly set up in any previous year, if his income from business or profession is likely to exceed 1,20,000 rupees or his total sales, turnover or gross receipts as the case may be in business or profession are or is likely to exceed 10 lakh rupees during the year. So, if either the income or sales or receipts are more than the given limits, books of accounts must be maintained. However, in case of a person being an individual or a Hindu undivided family, the provisions of clause 1 and clause 2 shall have effect as if for the words 1,20,000 rupees, the words 2,50,000 rupees had been substituted. And in the case of a person being an individual or a Hindu undivided family, the provisions of clause 1 and clause 2 shall have effect as if for the words 10 lakh rupees, the words 25 lakh rupees had been substituted. So, in case of an individual or HUF, the prescribed limits for maintaining books of accounts is higher as compared to other assessees. Let us come to section 44AB, audit of accounts of certain persons carrying on business or profession. Every person, clause A, carrying on business shall, if his total sales, turnover or gross receipts as the case may be in business exceed or exceeds 1 crore rupees in any year. However, in the case of a person whose aggregate of all amounts received including amount received for sales, turnover or gross receipts during the year in cash does not exceed 5% of the said amount, and clause B, aggregate of all payments made including amount incurred for expenditure in cash during the year does not exceed 5% of the said payments, this clause shall have effect as if for the words 1 crore rupees, the word 10 crore rupees had been substituted. Get his accounts of such previous year audited by an accountant before the specified date and furnished by that date the report of such audit in the prescribed form duly signed and verified by such accountant and setting forth such particulars as may be prescribed. In short, if the business or transaction of receipts and payments are done through online or digital channels and where the identity of paying and receiving parties can be easily established, it benefits the business by reducing the compliance burden. So such persons have to get their accounts audited. To relieve small taxpayers from such compliance burden, the Income Tax Act has been framed. The presumptive taxation scheme under section 44AD, 44ADA and 44AE. A person adopting the presumptive taxation scheme can declare income at the prescribed rate. The Act has provided the scheme as explained. Section 44AE, special provision for computing profits and gains of business of plying, hiring or leasing goods carriage. Subsection 1. Notwithstanding anything to the contrary, contained in sections 28 to 43C, in the case of an assessee who owns not more than 10 goods carriages at any time during the year and who is engaged in the business of plying, hiring or leasing such goods carriage, the income of such business chargeable to tax under the head profits and gains of business or profession shall be deemed to be the aggregate of the profits and gains from all the goods carriage owned by him in the year, computed in accordance with the provisions of subsection 2. And what does the subsection 2 says? For the purposes of section 1, the profits and gains from each goods carriage, number 1, Being a heavy goods vehicle shall be an amount equal to 1000 rupees per ton of gross vehicle weight or unladen weight as the case may be for every month or part of a month during which the heavy goods vehicle is owned by the SSC in the year, or an amount claimed to have been actually earned from such vehicle, whichever is higher. Number 2. Other than heavy goods vehicle shall be an amount equal to 7500 rupees for every month or part of a month during which the goods carriage is owned by the SSC in the year, or an amount claimed to have been actually earned from such goods carriage, whichever is higher. 3. Provided that where the SSC is a firm, the salary and interest paid to its partners shall be deducted from the income computed under subsection 1, subject to the conditions and limits explained in clause B of section 40. As per section 40 clause B, the remuneration on the first rupees 6 lakhs of book profit, or in the case of a loss is limited rupees 3 lakhs or 90% of the book profit, whichever is higher, on the balance of the book profit at the rate of 60% of the book profit. For the purposes of this section, A, the expression goods carriage, gross vehicle weight, unladen weight shall have the respective meanings assigned to them in section 2 of the Motor Vehicles Act 1988. Clause AA, the expression heavy goods vehicle means any goods carriage the gross vehicle weight of which exceeds 12,000 kilograms. B, an assessee who is in possession of a goods carriage, whether taken on hire, purchase or on installments, and for which the whole or part of the amount payable is still due, shall be deemed to be the owner of such goods carriage. Let us talk about ITR forms. ITR 3 is for individual and HUF engaged in business or profession. This form is to be used by assessees who cannot file ITR 1, ITR 2 and ITR 4. ITR 4 is for resident individual and HUF firm other than LLP, where the income is computed on a presumptive basis. In India, there are nearly 2.5 crore taxpayers who file ITR. Only taxpayers having income from any of the given sources not exceeding rupees 50 lakh is eligible to file ITR 4. The sources are: number 1, salary or pension; number 2, one house property; 3, other sources like interest, family pension, dividend, etc., excluding winning from lottery and income from race sources; number 4, agriculture income up to rupees 5,000; and number 5, long-term capital gains under section 112A up to rupees 1,25,000. ITR 4 form cannot be used by a person who is a director in a company, has held any unlisted equity shares at any time during the previous year. Number 3, has any asset including financial interest in any entity located outside India. Number 4, has signing authority in any account located outside India. Number 5, has income from any sources outside India. Number 6, is a person in whose case payment or deduction of tax has been deferred on ESOP. Number 7, has any brought forward loss or loss to be carried forward under any head of income. Number 8, has total income exceeding rupees 50 lakhs. Number 9, has income from short-term capital gains. And number 10, has income from long-term capital gains other than under section 112A up to rupees 1.25 lakhs. Please note that ITR 4 is optional and not mandatory. It is a simple form compared to ITR 3. However, one must be eligible to file ITR 4. Let us know about the category of assessees and their due date for filing of return. For individual and HUF, it is 31st July of the assessment year following the financial year. And for financial year 24-25, it has been extended up to 15 September. It is for the cases where the audit is not required. Now let us learn about the tax slab for individuals less than 60 years of age under section 115 BSc under the new regime for the financial year 2024-25. If an assessee has income of rupees 3 lakh, the tax liability is nil. From rupees 3 lakh 1 to rupees 7 lakh, the tax will be at the rate of 5%. From rupees 7 lakh 1 to rupees 10 lakh, tax will be at the rate of 10%. From rupees 15 lakh 1 to rupees 50 lakh, the tax will be at 30%. From rupees 50 lakh 1 to rupees 1 crore, tax will be at the rate of 30% plus a surcharge of 10%. And as per the last slab, if the income is above rupees 2 crore, the tax liability is at the rate of 30% plus a surcharge of 25%. Selection of tax regime. After the amendment by Finance Act 2024, the new tax regime is the default tax regime for an individual HUF. However, the assessee has the option to opt out and choose old tax regime. The option to switch to old tax regime and withdraw from it in any subsequent year can be exercised only once in the lifetime of a taxpayer having income from business and profession. For this purpose, Form 10 IEA has to be submitted before the due date of filing ITR. Let us learn about the rebate under section 87A. Under the old regime, an assessee being an individual resident in India whose total income does not exceed 500,000 rupees shall be entitled to a deduction from the amount of income tax as computed before allowing the deduction under the chapter on his total income with which he is chargeable for any assessment year of an amount equal to 100% of such income tax or an amount of 12,500 rupees, whichever is less. So under the old regime, the rebate amount is rupees 12,500. Now under the new regime, under section 115 BAC for the financial year 2024-25, where total income does not exceed 700,000 rupees, that is 7 lakh rupees, the assessee shall be entitled to a deduction from the amount of income tax as computed before allowing for the deduction under this chapter on his total income with which he is chargeable for any assessment year of an amount equal to 100% of such income tax or an amount of 25,000 rupees, whichever is less. So the rebate under the new scheme is up to rupees 25,000. The forms applicable for ITR: Form 16, it is certificate of tax deducted at source on salary and given under section 203. This is provided by employer to employee and gives the salary, income and TDS detail. Form 16A is for certificate of tax deducted at source on professional income. This is provided by deductor to deductee and it provides the nature of payments, income credited or paid and TDS detail. Form 26AS AIS Annual Information Statement. This is provided by the Income Tax Department and provides the income and TDS details. Please note down the income tax website address. It is eportal.incometax.gov.in. You can go to the home page for login. Login tab is provided in upper right hand corner. Please use PAN number to login, and if you are not yet registered, use your PAN to create your login ID. Once you have the necessary data available with you, log into the income tax return filing portal and follow the given steps. Normally, you will require the following: bank statements, housing loan certificate, interest and certificate, insurance receipts, rent receipts. The IT site is user friendly. Please link Aadhaar and PAN if not yet done. First, familiarize yourself with all the sections which you need to fill up. After filling up the data, there is a process of validation which ensures there are no logical errors. You can download the filled form for your review. If there are no discrepancies, you can do online verification. Please share this video with as many persons as possible so that they can also benefit. And you can write in the comment section for further clarification, feedback or a free consultation with me. I hope to get your encouragement to produce more such videos on matters of interest to the common man. Kindly like and share the video and subscribe to my channel. Thank you for watching. Have a good day.